The odds change as our position in the cycle shifts. If we fail to adjust our investment stance when these factors change, we are passively subjected to the cycles. In other words, we are missing the opportunity to turn the odds in our favor. It's an undeniable truth that few investors want to confront. The market doesn't operate in a straight line. It breathes, it fluctuates. It constantly alternates between euphoria and pessimism. It is these rhythms, these cycles, that determine an investor's success or failure. In Mastering the Market Cycle, Howard Marks doesn't promise a magic formula, nor does he offer day-by-day accurate predictions. Instead, he points to a different approach. Listening to the cycle, identifying one's position on its trajectory, and adjusting investment attitudes accordingly. From over half a century of experience navigating market waves, Marks shows that understanding cycles is the compass that helps us tilt the probabilities in our favor. What makes the book special isn't its dry definitions, but the way it poses questions that force us to think. Why do people always forget old lessons and repeat mistakes? Why does euphoria sow the seeds of recession and failure prepare the ground for recovery? Can we learn to ride alongside cycles instead of being swept away by them? And perhaps the most crucial question you'll carry into the next pages is, if cycles are immutable, will you choose to be a victim caught in their current, or someone who leverages their rhythm to go further? Part 1. Investing is a game of probabilities, not certainties. When we enter the market, we are betting on the future. But the future, by its very nature, is unknowable. This leads many people to fall into two extremes, either trying to minutely predict every macroeconomic fluctuation or giving up and submitting to the flow. Both approaches easily lead to failure. I believe the correct approach is to observe cycles. Cycles are the recurring rhythms of the economy, of profits, and of human psychology. They are not as regular as a clock, but neither are they entirely random. They are a synthesis of push and pull, of greed and fear, of hope and despair. And by recognizing our position within a cycle, we can tilt the scales of probability in our favor. Professional investing is an effort to outperform the average. Earning average returns is easy, but to go beyond the crowd, investors must find ways to adjust their strategies as the cyclical context changes. I don't believe in the ability to precisely predict the macroeconomic future. History shows that very few people succeed by forecasting what the economy or market will do. As Warren Buffett once said, information is only truly useful if it is both important and knowable. But macroeconomic forecasts often fail both conditions. They are important, but rarely does anyone know more than the general public. Therefore, instead of focusing on predictions, I concentrate on what is knowable: the fundamentals of a business, reasonable pricing, and especially the position within the cycle. To visualize this, imagine a glass jar containing 100 marbles, 70 black and 30 white. If you don't know the ratio, drawing a marble is just a game of chance. But if you know the probabilities beforehand, you have an advantage. Bet on black and you'll win more often than you lose. A good investor is like that, not knowing for sure what will happen, but possessing a superior understanding of trends and thus tilting the scales in their favor. This doesn't mean we'll always be right. Even knowing the probability is 70-30, there's still a 30% chance of being wrong. But repeat it many times, and the probabilistic advantage will yield results. In investing, it's the same. Knowledge of cycles doesn't give us certainty, but it gives us the ability to survive and succeed in the long run. The difference between an ordinary investor and an excellent one is the ability to listen to cycles. The ordinary person sees only discrete events, while the excellent person recognizes patterns. They ask, are we at the beginning or the end of a growth spurt? Have profits gone too far, to a dangerous extent? Is investor psychology driven by greed or fear? Is the market scorching hot or so cold that it's a good time to buy? It is through these questions that they know when to become more defensive and when to boldly attack. An excellent investor doesn't need to know the future precisely, only to understand where the cycle is leading us. When the economy and profits are likely to rise, when sentiment is still cautious, when prices are not yet too high, that is when opportunities open up. Conversely, when the crowd is euphoric, when risks are downplayed, when everything is praised as infallible, that is when danger lurks. Cycles are a reminder that everything is temporary. Euphoria will give way to pessimism. Growth will encounter recession. Investors cannot avoid market turbulence but can learn to navigate their ship. That is why I wrote this book, to show that if you listen to the cycle, if you recognize your position within that repeating rhythm, you will not be caught by surprise, not swept away, but can actively turn the cycle into an advantage. Many people tend to think of cycles as a series of events. After growth comes recession, after recession comes recovery. But to truly understand, we shouldn't just see them as connecting points, but recognize that each event is the cause of the next. When meeting clients, I often draw a straight line from the bottom left to the top right of a chart, symbolizing the long-term trend of the economy and market. Then I draw another wavy line oscillating around it. That is the cycle. This curve is never flat but always fluctuates around a central point. The cycle can be described as follows: recovery from a low point moving up to equilibrium, surpassing equilibrium, advancing to a peak, peaking, correcting, and returning near equilibrium, continuing to fall below equilibrium, hitting a bottom, then recovering again, and the process repeats. The important thing is that cycles have no absolute beginning or end. Any phase can be seen as a beginning or an end, depending on the perspective. That's why when someone asks me if the cycle is about to start or has ended, I often find the question imprecise. The correct question should be, where are we in this rhythm? I often compare cycles to a pendulum. A pendulum hangs from an equilibrium point but always swings to two sides. If we gradually move its suspension point from left to right, the pendulum's trajectory becomes a wavy curve. That is the cycle. The pendulum and the cycle are just two different ways of talking about the same phenomenon, oscillation around a central level. Mark Twain is said to have remarked, "History does not repeat itself, but it often rhymes." This quote, whether he actually said it or not, accurately describes the nature of cycles. Cycles do not repeat exactly, but their rhythm, their underlying reasons, always return. The central point of a cycle is often a long-term trend, such as economic growth or corporate profits. For example, GDP might grow an average of 2% per year, but each year it fluctuates around that figure. When it's faster, people are elated. When it slows down, they're pessimistic. This very oscillation creates the dance of the cycle. It's worth noting that when a cycle moves to an extreme, it automatically generates a pulling force in the opposite direction. When the economy performs too well, prices climb too high, optimism becomes excessive. That's when the seeds of recession are already formed. Conversely, when failure, pessimism, and fear are widespread, the seeds of recovery also begin to sprout. I often say, success contains the seeds of failure. Failure nurtures the seeds of success. Cycles do not simply return to equilibrium but often overshoot it. When the market recovers from low prices, it rarely stops at a reasonable level. Euphoria continues, pushing prices further to an excessively high point. Then, that very euphoria leads to collapse. In life and investing, this is the law of reversion to the mean. Everything will eventually return to a reasonable level, but rarely does it stop at that reasonable level. Things often swing past it and then oscillate to the opposite extreme. The further a cycle moves from equilibrium, the greater the destructive force when it reverses. A normal recovery only leads to a correction, but excessive euphoria will leave behind a brutal collapse. The further from the midpoint, the stronger the reversal, the more severe the consequences. Imagine an economy growing, corporate profits at record highs, stock prices soaring. The crowd believes this time is different, that old rules are obsolete. Then, with just a minor shock, all optimism is blown away and the stark truth emerges. The cycle never disappears. Cycles are even more complex because they are interconnected. The economic cycle affects the profit cycle, profit affects psychology. Psychology dominates financial markets, and the market, in turn, impacts the credit cycle. Then credit loops back to affect the economy. Cycles do not exist in isolation, but interweave into a complex network, where each movement triggers chain reactions. Understanding this, we realize that observing cycles is not about finding a start or an end point, but about learning to read the rhythm, grasp the trend, and prepare for the next step. If you want to grasp cycles, you must accept a paradox. They are both immutable and irregular. Immutable because there is always repetition growth then recession, euphoria then disappointment. Irregular because each repetition, the details are never exactly the same. This combination causes many people to either be overconfident that they can predict precisely or, conversely, to believe that cycles are merely an illusion. Both extremes are dangerous. I realize that humans are the greatest force pushing cycles far from equilibrium. When things are good, euphoric psychology prolongs the good times longer than reason allows. When times are tough, fear makes the crowd excessively pessimistic. Thus, it's not just objective circumstances, but human psychology itself that creates the momentum, causing the pendulum to keep swinging. One thing to remember: cycles are a chain of causes and effects. When an event reaches its extreme, it doesn't stop there but creates the conditions for reversal. When the market is high, values are inflated, capital is allocated too easily, risks are underestimated. These very factors give rise to the next collapse. Conversely, when everything falls into despair, prices hit rock bottom, investment freezes that, in turn, is the starting point for a recovery. I often say, success carries within it the seeds of failure, failure sows the seeds of success. This is not just a philosophical observation, but a vital rule in finance. For this reason, I rarely speak of the beginning or end of a cycle. Such concepts create the illusion that we can precisely mark specific points in time. In reality, cycles have no clear boundaries. They are like a winding river, with no specific spot you'd call the start of a bend, only a gradual change that becomes more distinct when we look back. One of the important characteristics of cycles is their ability to inflict greater losses the further they deviate from equilibrium. A superheated market creates erroneous behaviors: excessive borrowing, valuations far exceeding true value, and overconfident belief that this time is different. When the reversal occurs, the consequences are often not just a mild correction, but a collapse. Conversely, a market that falls too deeply often creates immense opportunities, because at the bottom, risk has been absorbed and recovery potential accumulates. We can take examples from historical financial cycles: the dot-com bubble of the late 1990s or the 2007-2008 global financial crisis. Both demonstrate that behind every boom always lie the seeds of collapse, and after every collapse comes the opportunity for rebuilding. The most frightening thing is human short-term memory. John Kenneth Galbraith pointed out in A Short History of Financial Euphoria that financial markets have an extremely short memory. Yesterday's lessons are easily forgotten, and a new generation, brimming with confidence, walks down the same old path. They dismiss historical warnings as outdated, only to repeat the exact same mistakes, just in different forms. A prudent investor must be aware that history rhymes. The details may change: one time it's real estate, another time technology, yet another time subprime credit, but the core theme never differs. Excessive euphoria will lead to collapse, and extreme fear will pave the way for recovery. This also leads to an important conclusion. Cycles are often symmetrical, with every boom balanced by a bust and vice versa. But symmetry here only applies to the direction, not to time or magnitude. A rally can last many years, while a collapse occurs in just a few months. Yet, the balance is ultimately restored. The decline often comes quickly and violently because a balloon deflates faster than it inflates, as my colleague Stone once said. Conversely, recovery can be slow because it takes time for confidence to return, for the economy to absorb old mistakes. So how do we take advantage of this characteristic? Not by trying to predict precise timing, but by observing the overall trend. Learn to sense when euphoria has gone too far, when fear has hit rock bottom. That is the time to adjust your investment attitude. Be more defensive when the crowd is blind, more courageous when they are desperate. Finally, remember that cycles do not operate in isolation, but are intertwined like a network. The economic cycle affects corporate profits, profits affect psychology. Psychology dominates the market, and the market impacts credit. Credit, in turn, affects the economy. It's a complex vortex where everything is connected and reflects one another. Recognizing this interdependence, investors should not seek a fixed formula, but cultivate an intuition for cycles, learning to listen, to recognize signs, and above all, to prepare for the inevitable. A common question I receive is, Are cycles truly regular? Many believe that to be called a cycle, it must be like a sine wave in mathematics oscillating smoothly, with stable amplitude and frequency, always returning to the exact starting point. If not, then it's merely random fluctuation. I once had an interesting debate with Nick Tran, a fund manager in London. He argued that phenomena in investing should not be called cycles because they lack the precise predictability of physics or mathematics. I agree that markets do not obey mechanical laws, but I countered that despite their irregularity, they still possess a cyclical nature. Look at human psychology. After euphoria comes weariness, after fear comes hope. Beliefs and emotions always fluctuate, and it is this very fluctuation that makes the market move in repeating rhythms. Yes, we cannot precisely measure peaks and troughs like a clock, but denying the cyclical nature just because it's irregular is like denying the existence of seasons just because the weather is different every year. This is a crucial point in investing. Cycles do not originate from mathematical formulas, but from humans with their psychology, emotions, short memories, and internal contradictions. Because humans are involved, cycles can be recognized but not precisely predicted. I recall a period in the high-yield bond market when the 2-year rule was widely circulated. Many bonds typically defaulted around 2 years after issuance. If that were a true rule, investors would simply need to sell all bonds before the 2-year mark and buy back the survivors after. But that was merely a statistical illusion. A few coincidences over a short period created a seemingly certain rule. This is evidence that human psychology always craves simple formulas and often equates randomness with regularity. It's important to emphasize that cycles are not exact repetitions, but recurring tendencies. When a factor reaches an extreme, it creates momentum for reversal. When the market is overly expensive, investors will suffer losses, and that failure, in turn, paves the way for caution and cheap prices to return. When the market is too cheap, courageous participants will reap profits, and that success, in turn, sows the seeds for new euphoria. A wise investor does not seek certainty, but looks for signs of tendencies. Let me offer an image. If we throw a ball into a river, it will float in the general direction of the current. But the waves, whirlpools, and impacts with the banks will make its path sometimes fast, sometimes slow, sometimes retreating, sometimes advancing. We cannot precisely measure its journey, but we know for sure that it will not stand still. Similarly, the economy and markets generally trend upward in the long run due to productivity and progress. But around that trend, psychological and random fluctuations create short-term waves. The irregularity in the rhythm does not negate their repeating nature. There's a truth many find hard to accept. Cycles contain an element of randomness. Humans tend to attribute causes to every outcome because uncertainty makes us uncomfortable. We want to believe that success or failure has clear reasons, but in reality, as Leonard M. Lodino writes in The Drunkard's Walk**, randomness is fundamental to life, and finance is no exception. A company might report good profits, yet its stock price falls due to external factors, changing interest rates, a competitor launching a new product, or simply a general market downturn. Therefore, we should not wait for a mechanical formula. The power of studying cycles lies elsewhere. It helps us understand that history has a rhythm, that euphoria is always followed by fear, and extreme fear often opens up opportunities. Observing history, I see one thing for sure: the market will always continue to go up and down. But I never know exactly when, how fast or slow, how high or low. What I do know, and it's enough to give me an advantage, is that most investors understand less about cycles and care less. Just by paying attention, you already have an advantage over the crowd. Cycles are not as regular as natural science, but they are still cycles. And just by understanding this nature, you have taken a big step forward to avoid falling into the trap of blind optimism or extreme fear. If we want to understand cycles, we cannot ignore the economic cycle, the foundation of all other movements in the market. The economic cycle is the rhythm of growth and recession of the entire economy, and it creates ripple effects on corporate profits, financial markets, psychology, and credit. Imagine a gently sloping upward line representing the long-term growth rate of the economy. This line is formed by sustainable factors: population growth, technological progress, improved labor productivity over decades. This line may slow down but rarely reverses. That is the long-term trend. But around that line, reality is a wavy curve. One year the economy grows faster, another year it slows down, occasionally falling into recession and then recovering. The average might be 2%, but in reality, there are years of 5% and years of -3%. It is this oscillation that keeps investors in a state of anxiety and euphoria. The economic cycle can be described in 4 phases. 1. Expansion. Output increases, employment is abundant, low interest rates stimulate consumption and investment. 2. Peak. The economy operates at full capacity, costs rise, inflation appears. 3. Recession. Production declines, unemployment rises, spending contracts. 4. Recovery asterisk. After hitting bottom, confidence gradually returns, spending increases, the economy revives. The special point is that each phase leads to the next. When the economy expands for too long, inflationary pressures and rising costs force central banks to tighten policy. This increases borrowing costs, reduces consumption, and pulls the economy into recession. Then, recession itself creates the conditions for recovery. Interest rates fall, costs are contained, inventories become cheaper, demand returns, the cycle thus never stops. A factor that strengthens the economic cycle is collective psychology. When people believe the economy is growing, they spend more, businesses invest and expand, banks lend easily. This confidence reinforces itself until it becomes excessive. When reality bites, profits fall, costs are high, confidence collapses, and pessimistic psychology makes the recession deeper than necessary. We can see that the economic cycle is not just a story of output and employment, but a story of people. Workers spend more when they feel their jobs are secure. Businesses increase investment when profits are abundant. Governments believe growth is the result of their policies. And then, when everything turns, everyone retreats, making the recession even more severe. Another point, economic cycles are not uniform in duration and magnitude. There are periods of growth lasting a decade, like after World War II, but also rapid and deep recessions, like the 2008 crisis. This reminds us that we cannot predict precisely, but we can identify when the economy has run too hot or when it has cooled to an unreasonable extent. I recall the years before the 2008 crisis. Continuous growth, low unemployment, easy credit. People believed a new paradigm had emerged, that the old cycles had been eliminated. But in reality, that very euphoria sowed the seeds of the collapse. And when the crisis hit, people went to the opposite extreme, believing the economy would never recover. In fact, recovery began even in the darkest moments of pessimism. The economic cycle is also influenced by demographics and technology. An aging society will have slower growth because the workforce shrinks. Conversely, technological breakthroughs can increase productivity, pushing the long-term trend line upward. But no matter what, the oscillation around that trend will always exist because humans never move in a straight line. Understanding the economic cycle does not help us avoid fluctuations, but it helps us prepare our mindset. When expansion lasts too long, be cautious. When recession is too deep, be patient. Investors cannot control the economy, but they can control their reactions to its waves. And that is the advantage. The economic cycle is already complex, but government intervention makes it even more unpredictable. Fiscal and monetary policies are designed to smooth out fluctuations, but not infrequently. Instead of neutralizing them, they inadvertently amplify volatility. When the economy is in recession, governments often spend more and cut taxes, while central banks lower interest rates and inject liquidity. The goal is to stimulate demand and lift the economy from its bottom. Conversely, when growth is too hot and inflation is high, policies tighten, taxes increase, spending cuts, interest rates rise. This is how the pendulum is adjusted to keep the economy close to equilibrium. However, reality shows that policies are rarely timely. Often, government actions come too late. When the economy has already entered a new phase, a strong stimulus package might arrive just as the economy is self-recovering, resulting in an overdose. This pushes the cycle into new euphoria. Conversely, excessive tightening when recession is already looming can cause the economy to fall deeper. Recall the 2008 global financial crisis. The credit bubble had been forming for years, but loose policies continued. Interest rates were too low, credit was too abundant, debt was rampant. All contributed to fueling the fire. And when the crisis erupted, the government's hasty response was to inject massive capital and cut interest rates to near zero. This helped prevent a complete collapse, but also sowed the seeds for new risks. The cycle, therefore, was not eliminated. It was merely postponed. It can be said that governments have the ability to reduce the amplitude of fluctuations, but cannot eliminate them entirely. Sometimes, policies even create secondary cycles. When the crisis hadn't even ended, rescue measures caused financial markets to surge while the real economy was still in much pain. The result was two overlapping rhythms, making it even harder for investors to navigate. If the economic cycle is the big picture, then the corporate profit cycle is a close-up of each color in that picture. Profits do not move in a straight line. They fluctuate with changes in the economy, consumer demand, production costs, competition, and technological innovation. When the economy expands, sales increase, fixed costs are spread over larger output, and profits soar. Conversely, when there's a recession, sales decline, but costs cannot shrink immediately, causing profits to plummet, often faster than even revenue. That's why profits magnify the economic cycle. Growth becomes more brilliant, recession becomes more brutal. During expansion, businesses benefit from a combination of strong demand and stable costs, leading to surging profits. Financial reports look rosy, investors are elated. But it is at this very moment that the seeds of decline are sown. New competitors enter, production capacity expands, labor and raw material costs escalate. What was once an advantage now becomes a burden. When the economy slows, revenue contracts, but costs are difficult to reduce accordingly. Fixed costs like depreciation, rent, and interest payments still need to be made. Profit margins drop rapidly, often turning negative. And like every other cycle, this decline not only reflects the current situation, but also creates the conditions for subsequent recovery. One of the greatest paradoxes I have ever witnessed is that the highest profits often appear just before a recession, and the lowest profits just before a recovery. This is not a trick of fate, but an inevitable logic. When profits peak, everyone has expanded to the maximum. Prices have climbed to their highest, competition is fierce, there's no more room for growth. The pendulum inevitably swings back. When profits hit bottom, businesses have cut back, excess capacity is purged, prices fall to attractive levels. The conditions for recovery are ready. This is why profits are not an absolutely reliable indicator to forecast the future. When they look their best, risk can be at its highest. When they look their worst, opportunity opens up. But most people fall into the opposite trap, buying when profits are strong and selling when profits are poor. Look at heavy industry or transportation. When demand explodes, factories run at full capacity, profits are high. But then, in that very euphoria, they build more factories, order more ships, take on more debt. By the time demand weakens, there's oversupply, borrowing costs still weigh heavily, and profits evaporate. The cycle repeats. Profits are a magnifying mirror of the economy. They show how easily people are deceived by short-term numbers, while the true nature lies in the long-term rhythm. Too high will fall deep, extreme darkness will pave the way for light. Looking closer at the profit cycle, we realize it's not just a result of the overall economy or operating leverage. It's also shaped by competition, an invisible yet fierce force that keeps profit margins from ever staying still. During prosperous times, when profits are high, businesses cannot sit idly by. Expansion becomes the mantra. Factories spring up, workers are hired, capital borrowing accelerates. The success of one company quickly attracts rivals. The rush of participation leads to supply exceeding demand, and seemingly sustainable profits begin to thin. It is at this moment that the seeds of decline are quietly forming. Conversely, during periods of recession, when profits fall, businesses scale back production, cut costs, and many companies even go bankrupt. The consequence is reduced competition, shrinking supply, and lower cost bases. These are the conditions for profits to recover. When others give up, the patient remain and reap the rewards. A classic example is the airline industry. When air travel demand is high, airlines compete to buy new planes and open more routes. In the short term, revenue increases and profits boom. But this boom leads to an arms race. Fleets swell, price competition becomes fierce. And just a few years later, profits plummet. Then, when a recession sweeps through, many airlines cannot bear the enormous costs, going bankrupt or merging. The market shrinks, ticket prices rise, profits return, and the cycle continues. The frightening thing here is the blindness to the recent past. When profits are high, people believe they will last forever. When profits are low, despair makes them think light will never return. But history has proven that cycles always operate, differing only in speed and magnitude. This leads to an important consequence. Extreme profits are often a warning sign, while extremely low profits are often a sign of opportunity. But human psychology leads most investors to act in reverse. They pour money in when financial reports are brilliant and flee when numbers are terrible. In reality, when profits peak, stock valuations are also inflated. People see current numbers as the new normal, failing to realize that such profitability is difficult to sustain. Conversely, when profits are low, stock prices often reflect extreme pessimism. And if one can see through the fog, investors will find rare opportunities. In other words, profits are not just a result of the cycle, but also its engine. When businesses reap much, they sow seeds for increased competition and costs. When they suffer losses, the very contraction creates fertile ground for subsequent success. For investors, understanding the profit cycle means not letting current numbers blind them. We must put them in context. We must ask ourselves, is this the peak of euphoria or the bottom of decline? Only by doing so can we avoid the trap of the crowd and forge our own path in the world of investing. Psychology and attitude towards risk are two sides of the same coin. They operate like two major branches of the emotional pendulum, always oscillating from one extreme to another. When the market is euphoric, optimism prevails. Investors believe that risk has virtually disappeared. They are willing to pay any price for any asset, believing that the future will remain bright forever. Familiar phrases appear. This time is different. Old rules no longer apply. Growth will never stop. In those moments, risk seems lowest. But precisely because everyone believes risk is low, they act carelessly, and that causes actual risk to increase to its highest. Conversely, when fear is rampant, investors see only darkness. They believe risk is unacceptable, that all investments are dangerous. The market falls into a sell-off, asset prices drop below their true value. But it is in that very darkness that opportunities emerge for those brave enough to see beyond the fear. The important thing is that the psychological pendulum never stands still. It rarely stops at the rational equilibrium point because humans are inherently driven by emotion. When the market is good, few can remain cautious. When the market is bad, few maintain optimism. And thus, we always oscillate around rationality but very rarely stay exactly in the middle. Benjamin Graham, Warren Buffett's teacher, said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." In the short run, prices reflect only crowd psychology: who is more optimistic, who is more pessimistic. Only in the long run do prices return to reflect true value. But between those 2 points, the psychological pendulum dictates the journey, and sometimes it pulls the market very far from reality. Look at the dot-com bubble of the late 1990s. At that time, investors believed the internet would change everything, but they also believed that any company with "com" attached was worth billions of dollars. Extreme euphoria pushed tech stock prices sky high. Then, just a few years later, the pendulum reversed. A slew of companies went bankrupt, the market collapsed, and trust vanished. But it was at that very moment that truly valuable businesses like Amazon began their ascent. Or the 2008 financial crisis. Before that, the credit market was dominated by blind optimism. People believed real estate never loses value, that borrowing was safe. The pendulum swung to the extreme of greed. When the bubble burst, sentiment shifted to the extreme of fear. People believed the financial system would collapse, that there was no hope left. And right in that moment, opportunities for a new generation of investors began to form. Thus, the psychological cycle is not just a part of the market, it is the heart of the market. The question is, how do we face this pendulum? The answer does not lie in precisely predicting when it will reverse. That is impossible. But we can recognize when it has swung too far, when euphoria becomes dangerous, and when fear has opened up opportunities. I often remind colleagues, when everyone agrees that risk is low, risk is actually at its highest. Conversely, when everyone believes risk is unbearable, that is precisely when risk has been absorbed into prices and profit potential increases. This leads us to a key truth. Successful investing doesn't come from following the crowd, but from recognizing where the pendulum is and daring to act against it. When others are too greedy, be cautious. When others are too fearful, be courageous. The psychological cycle is the culmination of this journey because it ties together everything we've discussed: economics, profits, policy. All of it only becomes real in the market when filtered through human emotion, and it is there that opportunity and danger walk hand in hand. Part 2, profits, seemingly the most objective numbers in business, are also caught in the repeating rhythm of cycles. People often assume that if the economy goes up, profits will steadily improve. If the economy goes down, profits will simply decrease. But the reality is far more complex. Profits not only move with the economy, but also fluctuate more violently than the economy, like an echo significantly louder than the original sound. The reason lies in operating leverage. When revenue increases, fixed costs are spread over larger output and profit margins soar. A manufacturing company with an equipped factory and machinery can produce thousands more products at low marginal cost. Revenue nudges up, but profits leap. Conversely, when revenue declines, fixed costs remain unchanged, causing profits to fall sharply, even faster than revenue. That's why profits amplify the economic cycle. Growth becomes more brilliant, recession becomes more brutal. During expansion, businesses benefit from a combination of strong demand and stable costs, leading to surging profits. Financial reports look like dreams, investors are elated. But at this very moment, the seeds of decline are sown, new competitors enter, production capacity expands, labor and raw material costs escalate. What was once an advantage now becomes a burden. When the economy slows, revenue contracts, but costs are difficult to reduce accordingly. Fixed costs like depreciation, rent, and interest payments still need to be paid. Profit margins drop rapidly, often turning negative. And like every other cycle, this decline not only reflects the current situation, but also creates the conditions for subsequent recovery. One of the greatest paradoxes I have ever witnessed is that the highest profits often appear just before a recession, and the lowest profits just before a recovery. This is not a trick of fate, but an inevitable logic. When profits peak, everyone has expanded to the maximum. Prices have climbed to their highest, competition is fierce, there's no more room for growth. The pendulum inevitably swings back. When profits hit bottom, businesses have cut back, excess capacity is purged, prices fall to attractive levels. The conditions for recovery are ready. This is why profits are not an absolutely reliable indicator to forecast the future. When they look their best, risk can be at its highest. When they look their worst, opportunity opens up. But most people fall into the opposite trap, buying when profits are strong and selling when profits are poor. Look at heavy industry or transportation. When demand explodes, factories run at full capacity, profits are high. But then, in that very euphoria, they build more factories, order more ships, take on more debt. By the time demand weakens, there's oversupply, borrowing costs still weigh heavily, and profits evaporate. The cycle repeats. Profits are a magnifying mirror of the economy. It shows how easily people are deceived by short-term numbers, while the true nature lies in the long-term rhythm. Too high will fall deep, extreme darkness will pave the way for light. Looking closer at the profit cycle, we realize it's not just the result of the general economy or operating leverage. It's also shaped by competition, an invisible yet fierce force that keeps profit margins from ever staying still. During prosperous times, when profits are high, businesses cannot sit idly by. Expansion becomes the mantra. Factories spring up, workers are hired, capital borrowing accelerates. The success of one company quickly attracts rivals. The rush of participation leads to supply exceeding demand, and seemingly sustainable profits begin to thin. It is at this moment that the seeds of decline are quietly forming. Conversely, during periods of recession when profits fall, businesses scale back production, cut costs, and many companies even go bankrupt. The consequence is reduced competition, shrinking supply, and lower cost bases. These are the conditions for profits to recover. When others give up, the patient remain and reap the rewards. A classic example is the airline industry. When air travel demand is high, airlines compete to buy new planes and open more routes. In the short term, revenue increases and profits boom. But this boom leads to an arms race. Fleets swell, price competition becomes fierce. And just a few years later, profits plummet. Then, when a recession sweeps through, many airlines cannot bear the enormous costs, going bankrupt or merging. The market shrinks, ticket prices increase, profits return, and the cycle continues. The frightening thing here is the blindness to the recent past. When profits are high, people believe they will last forever. When profits are low, despair makes them think light will never return. But history has proven that cycles always operate, differing only in speed and magnitude. This leads to an important consequence. Extreme profits are often a warning sign, while extremely low profits are often a sign of opportunity. But human psychology leads most investors to act in reverse. They pour money in when financial reports are brilliant and flee when numbers are terrible. In reality, when profits peak, stock valuations are also inflated. People see current numbers as the new normal, failing to realize that such profitability is difficult to sustain. Conversely, when profits are low, stock prices often reflect extreme pessimism. And if one can see through the fog, investors will find rare opportunities. In other words, profits are not just a result of the cycle, but also its engine. When businesses earn a lot, they sow the seeds for increased competition and costs. When they suffer losses, the very contraction creates fertile ground for subsequent success. For investors, understanding the profit cycle means not letting current numbers blind them. We must put them in context. We must ask ourselves, is this the peak of euphoria or the bottom of decline? Only by doing so can we avoid the trap of the crowd and forge our own path in the world of investing. Psychology and attitude towards risk are two sides of the same coin. They operate like two major branches of the emotional pendulum, always oscillating from one extreme to another. When the market is euphoric, optimism prevails. Investors believe that risk has virtually disappeared. They are willing to pay any price for any asset, believing that the future will remain bright forever. Familiar phrases appear. This time is different. Old rules no longer apply. Growth will not stop. In those moments, risk seems lowest. But precisely because everyone believes risk is low, they act carelessly, and that causes actual risk to increase to its highest. Conversely, when fear is rampant, investors see only darkness. They believe risk is unacceptable, that all investments are dangerous. The market falls into a sell-off, asset prices drop below their true value. But it is precisely then that actual risk is low, because it has already been absorbed into the price. Here we see an important paradox. Risk is not measured by numbers but by human behavior. When people think risk is low, they often inadvertently make it high. When they believe risk is high, their defensive actions make the market safer for those brave enough. This explains why investor psychology and attitudes toward risk always follow cycles. When recent profits are good, they believe risk has vanished, ready to borrow and invest indiscriminately. When profits are bad, they tighten standards, refuse to lend, and withdraw capital even from healthy opportunities. Attitudes toward risk directly affect the cost of capital. When sentiment is euphoric, standards are lax, capital becomes cheap, and everyone rushes to invest. That pushes asset valuations high, eroding future profits. When sentiment is pessimistic, standards are strict, capital becomes expensive, few dare to borrow, asset prices fall to low levels, and future profits become attractive again. We can see that the attitude toward risk operates as a self-amplifying spiral. Optimism creates relaxed behavior creates more investment creates illusory profits. Profits, in turn, feed more optimism. Until the spiral bursts, pessimism pulls everyone to tighten up. Tightening leads to a lack of capital. A lack of capital makes the recession deeper. Recession, in turn, feeds more pessimism. For the astute investor, this is a golden opportunity to go against the flow. When the crowd believes risk has disappeared, that is the time to be cautious. When the crowd thinks risk is too great, that is the time to be brave. But going against the grain is never easy. It requires a deep understanding of the psychological cycle and, above all, the courage to act differently. History has proven that the greatest profits often belong to those who dare to buy when others are terrified, and dare to sell when others are frenzied. I realize that psychology and risk are not just auxiliary factors of the market, they are its core. Because every cycle economic, profit, credit is ultimately filtered through the lens of human psychology. It is how people perceive risk that determines the flow of capital, and that flow, in turn, either nurtures or stifles the next cycle. When you understand this, you will see that the important thing is not to measure risk with models or statistics. The important thing is to sense where the psychological pendulum is, and that intuition, if trained, can become an investor's most sustainable competitive advantage. Among all cycles, the credit cycle is perhaps the most powerful driving force for the peaks and troughs of financial markets. For credit is the lifeblood of the system. When the flow is smooth, all activities expand. When it is obstructed, the entire economic body falters. The familiar starting point of the credit cycle is when the credit window swings wide open. In this phase, capital seems limitless. Banks and investors are willing to lend, ready to buy anything issued. Underwriting standards are relaxed. Previously strict conditions disappear. Less creditworthy borrowers still receive funding. Companies with weak balance sheets can still issue bonds, and even risky ventures get financed. The cause begins with optimistic psychology. When the economy and profits are rising, default rates are low, investors believe risk has vanished. They look at recent data and conclude, we are living in an unprecedentedly safe era. As a result, they are willing to accept lower interest rates and easier terms. The interesting thing is that precisely when people believe risk is low, they create the highest risk environment. When capital is cheap and abundant, it is allocated indiscriminately, funding weak projects, incompetent companies, and ventures that only survive on blind faith. Such loans will inevitably explode when circumstances change. In the credit expansion phase, borrowers benefit in every way. They can raise capital at low cost, extend maturities, and even take on more debt without being questioned. Weak businesses have a chance to survive, even to grow large. Huge mergers and acquisitions appear, all based on the assumption that cheap capital will last forever. But history shows that periods of easy credit always end in pain. Because when too much money is lent with too low standards, risk accumulates. Just one shock from the economy, falling profits, rising interest rates, or even just one prominent default, and the entire system begins to doubt. And as doubt spreads, the wide-open credit window suddenly slams shut. Those who lived through the 2008 financial crisis surely cannot forget this image. Before that, subprime credit was issued en masse, securitization was rampant. Standards were almost non-existent. Financial institutions believed all risk had been diversified, but in reality, risk was merely hidden. When the bubble burst, the truth emerged. A multitude of assets were financed by weak debt, and the entire system almost collapsed. But we don't need such a distant example. Anytime you see investors accepting unusually low yields when borrowing terms are unreasonably easy, understand that the credit cycle is at its dangerous extreme. That is when risk is highest, even when superficially everything seems calm. It must be emphasized that the credit cycle is not determined by mathematical models, but by human emotions. Optimism leads to laxity, laxity leads to misallocation. Misallocation leads to losses, losses lead to pessimism, and pessimism, in turn, makes credit tight. Then the cycle begins again. In this early stage, when credit opens, everyone feels like they're winning. Borrowers have cheap capital, lenders receive fees and seemingly reasonable interest rates. The stock market also booms thanks to cheap capital inflating valuations. But that is short-term prosperity built on a fragile foundation. That's why I always remind people, look at the attitude of the credit market. It is a more honest indicator than even the stock market. When credit expands excessively, you know that the seeds for a downturn have appeared. When the credit window closes, the picture becomes entirely different. If in the previous stage capital flowed like a flood, now it shrinks to scarce trickles. Loans that were once easy to get now disappear or come with suffocatingly strict conditions. During this period, fear spreads. Lenders remember past losses. They become cautious, even suspicious of customers once considered safe. Credit standards tighten. Borrowers with good balance sheets are still denied. New bond or stock issues fail en masse, and even viable projects are postponed because funding cannot be found. The consequence is that the economy, which relies on credit flow, immediately stalls. Businesses cannot expand and may even have to contract. Weak companies that survived on cheap debt now have no choice but to declare bankruptcy. Pessimism further tightens the spiral. Lenders see increasing defaults and withdraw further, causing risk to increase even more. However, for discerning investors, the period of credit scarcity is when opportunities open up. When few are willing to provide capital, those who remain have the power to set conditions. This is when yields are high, assets are undervalued, and buyers can negotiate from a position of strength. In the coldness of fear, the seeds of future profits are sown. This creates the familiar paradox of the market. When credit is easiest, risk is highest, and when credit is tightest, opportunity is greatest. But most investors are drawn by appearances. They rejoice when credit opens and panic when it closes. This reversal of perception creates an advantage for those who can see differently. The credit cycle is thus like the market's breath. Inhale too deeply and you must exhale forcefully. Exhale for too long and eventually you will inhale again. No one knows the exact moment of transition, but the signals are clear. Unusually low interest rates, easy borrowing terms are signs of a peak. Capital scarcity, stringent borrowing conditions are signs of a bottom. Historically, every recession bears the mark of a credit crunch. The collapse of subprime credit in 2008 is a prime example, but not an exception. Before that were the Latin American debt crisis of the 1980s and the Asian crisis of the late 1990s. Each time the motif was the same: credit loosened excessively, capital was misallocated, a bubble formed. Then, when the bubble burst, credit was suddenly withdrawn, leading to a cascade of failures. When you understand this, you will see that the credit cycle is the clearest projection of human psychology onto the market. It begins with excessive confidence, passes through ease, ends with extreme fear, and then returns to equilibrium. The calm observer will not ask whether credit is opening or closing. They will ask themselves, where are we on this pendulum's arc, and what is the logical course of action? Because in investing, it is not always wise to follow the flow. Sometimes one needs to pull back when the crowd rushes in, and sometimes one needs to step forward when they flee. The credit cycle, with its openings and closings, is the stage where courage and understanding are most severely tested in the world of finance. There is a particularly brutal cycle where participants can fall from the pinnacle of power to the abyss of bankruptcy in just a few years, the distressed debt cycle. Its sequence repeats like a pre-written tragedy. It begins with a bond issuance boom. When credit is easy, companies rush to borrow, bonds are sold, capital flows into the hands of even weak businesses. Buyers don't hesitate, as long as the interest rate seems attractive. Next comes declining quality. As demand for capital is easily met, standards loosen. Risky loans easily slip through. Then when the economy worsens, revenue declines and borrowing costs become burdensome. Many companies can no longer repay their debts and defaults skyrocket. At this point, buyers withdraw and the bond market almost freezes. No one wants to touch burning assets, prices plummet tragically. Bonds once sold at 100 are now 40, 30, even 10. Investors panic, fleeing at any cost. Then comes the restructuring phase. Some companies go bankrupt, some renegotiate with creditors, converting debt into equity. Once worthless debts suddenly become opportunities for new buyers. Finally, as the economy recovers, bonds once considered junk revive. Prices increase again, buyers rush back, and the cycle begins anew. What's notable about the distressed debt cycle is how clearly it exposes the nature of cause and effect. Each link leads directly to the next. The ease of credit gives rise to a boom in issuance. A boom in issuance leads to a decline in quality. Poor quality, encountering an economic crisis, will create defaults. Defaults cause buyers to withdraw. Buyers withdrawing pushes prices to rock bottom. Rock bottom prices, in turn, open the way for restructuring opportunities. All are connected in an unbreakable chain. For investors, distressed debt is a harsh but promising playing field. When the market is at its bottom, those brave enough to buy will reap large profits when recovery arrives. But it requires not just courage but meticulous analysis, distinguishing which companies can be reborn and which are sure to disappear. If the distressed debt cycle demonstrates the fragility of borrowed money, the real estate cycle shows the stubbornness of physical supply and demand. Real estate is particularly sensitive to credit. To build a building or an urban area requires enormous capital and a long time. In the euphoria phase, credit is cheap and projects boom. But unlike stocks, which can be issued instantly, real estate takes many years to complete. By the time projects enter the market, demand has changed and oversupply appears. The familiar rule repeats. When housing prices rise, everyone believes they will keep rising. Borrowers buy homes, developers borrow to build new ones. Banks compete to offer mortgages, but at that very moment, the bubble quietly inflates. When interest rates rise or the economy slows, demand retreats. Half-finished projects become burdens. Excess supply causes prices to plummet, fear spreads, banks incur bad debts, buyers lose confidence, projects are abandoned. Prices fall below construction costs. Then, like all other cycles, extreme pessimism opens up opportunities. When few dare to invest, patient individuals can buy assets for less than replacement cost. And when demand recovers, real estate returns and huge profits appear. The real estate cycle is also special due to its very long lags. A project can take 3–5 years from groundbreaking to completion. This often causes supply to exceed demand just when the market no longer needs more, and conversely, a lack of supply when the market recovers. This timing mismatch makes real estate one of the strongest cyclical markets. Seen from above, both distressed debt and real estate reflect a common principle. People always forget cycles during euphoria. They think success will last forever and borrow excessively. In despair, they think failure is permanent and give up, even when opportunities are forming. For the astute investor, the lesson from these two cycles is clear. Be skeptical when everyone believes, and be courageous when everyone flees, because it is at these two extremes that fortunes are shaped. After going through each link: profits, psychology, risk attitude, credit, distressed debt, real estate, we clearly see that no cycle exists independently. They are interconnected, feeding each other and together creating a larger rhythm, the market cycle. This is not a machine operating according to rigid formulas. On the contrary, it is a synthesis of many forces, sometimes in phase, sometimes out of phase. But the common thread is that all fluctuate from one extreme to another. And it is this fluctuation that draws the peaks and troughs that investors must confront. When the economy grows, corporate profits boom, psychology is euphoric, attitudes toward risk are lax, credit opens, real estate is vibrant, all combine to push the market higher. In that moment, it seems no force can stop it. But this very synergy also sows the seeds for reversal. When one factor changes direction, profits stall, credit tightens, or real estate faces oversupply, the entire chain reaction begins, and the market turns. Conversely, in a recession, all factors are tinged with gloom. Profits decline, psychology is pessimistic, risk is exaggerated, credit freezes, real estate plummets. People see only collapse, believing the future is endlessly dark. But precisely when all factors are at their worst, the market prepares to recover because there's nothing left to lose. Prices are cheap, risk has been absorbed, and each link in the chain begins to reverse. An important point to remember: the market cycle cannot be precisely timed. No one knows the exact day the market will peak or bottom, but we don't need that. What we need is to identify extreme states, when people are overly optimistic, when they are overly pessimistic. By identifying the extremes, we don't need a clock, only a compass. This is why I emphasize, act according to what the environment is revealing. No need to play prophet. When credit is too easy, be defensive. When profits are unreasonably high, be cautious. When real estate is inflated, be skeptical. Conversely, when defaults are rampant, when sentiment is gloomy, when credit is frozen, when real estate is abandoned, that could be an opportunity to prepare for attack. The core idea is that events themselves provide enough guidance for what actions to take. No need to forecast next year's inflation or next quarter's GDP. Just observe the present. Is credit opening or closing? Is sentiment leaning towards greed or fear? Are profits swelling or shrinking? What we see today already contains hints for tomorrow. Of course, no one can be right all the time, but success in investing does not require omnipotence. It only requires tilting the probabilities in your favor. If you avoid major mistakes when the market is too hot and seize a few clear opportunities when the market is too cold, you will far surpass the majority. Looking back at history, from the dot-com bubble to the financial crisis, from real estate cycles to credit cycles, we see a familiar refrain: everything will eventually reverse. The market is never permanently at its peak, nor permanently at its bottom. The only difference is whether you are prepared to go against the crowd or be swept away by the general psychological pendulum. The market cycle, therefore, is not an enemy. It is a map. The unsuccessful person is the one blindly chasing every short-term wave. The successful person is the one who knows how to read the map, knows that every extreme is a sign of a turn, and dares to act accordingly. And that is the art. No need for prophecy, just observation and preparation. Part 3. The first thing I must emphasize is that no one can precisely predict the peaks and troughs of cycles. The market is not a clockwork machine. It does not operate with a regular rhythm that we can set our watches by. Instead of dreaming of the ability to know tomorrow, it is more practical to learn how to behave wisely with cycles. The greatest danger comes from the belief that someone can foresee the future. How many economists, investors, central bankers have confidently made predictions and then been wrong? Past statistics show that most macroeconomic forecasts are useless. Even if someone guesses correctly, it's usually coincidental, not a repeatable skill. So what can we do? The answer lies in abandoning the illusion of forecasting. Instead, focus on observation. Instead of asking, when will the recession occur? We should ask, where is the market currently on the cycle's axis? Because only by recognizing the current state can we adjust our behavior to tilt probabilities in our favor. Here, it must be emphasized that dealing with cycles is not an impulsive act driven by emotion, but a process of observing extreme signals. For example, when credit is too easy, when valuations far exceed true value, when crowd sentiment is immersed in euphoria, those are signs of danger. Conversely, when defaults are widespread, when investors are extremely pessimistic, when asset prices are sold off, those are signs of opportunity. In practice, this means not needing to know precisely whether today is a peak or a trough, but we can recognize when risk is heavily skewed to one side. And simply by adjusting our portfolio accordingly, we are one step ahead of the crowd. Recall the dot-com bubble of the late 1990s. At that time, no one could say exactly which day the market would burst, but the signs of an extreme were clear. Irrational valuations, unprofitable companies being hailed, the belief that the internet would eliminate all cycles. The discerning person didn't need to predict the day of collapse, only to understand that the risk was too great and reduce their participation. Conversely, after the bubble burst, the good companies that survived became great opportunities for the patient. This is the difference. Forecasting is a game of arrogance, while observation and adaptation are an art of humility. The market always contains elements of surprise, and we cannot control it. But we can control our reactions. When the market is hot, we can choose to hold back. When the market is cold, we can take a step forward. This approach doesn't require genius, only patience and discipline. More importantly, don't believe you need to be 100% correct. No one achieves that. Success in investing is not about predicting every peak and trough, but about avoiding major mistakes and seizing a few clear opportunities. If you know how to stand on the sidelines when the crowd loses its mind and dare to step in when they are most fearful, you have come a very long way compared to the rest. So, dealing with cycles means observing extremes, adjusting strategy, and accepting uncertainty. It's not as flashy as declaring precise recession forecasts, but it is sustainable, humble, and realistic. And in the world of investing, that is the reliable path. Dealing with cycles doesn't require us to become prophets. It demands a more humble but far more important skill: identifying extreme signals. Peaks and troughs of cycles never come with road signs, but they leave clear clues for those willing to observe. Let me recount the familiar signals. When the market is on the dangerous side, you will see valuations soaring past all historical standards. Price-to-earnings, price-to-sales ratios are pushed to irrational levels. People justify it by saying that new models will render old norms obsolete. Credit is easy. Banks lend without requiring solid collateral. Huge borrowing deals are financed in a flash. Issuers set conditions, buyers accept unconditionally. Sentiment is frenzied. The crowd believes risk has disappeared. The common refrain is, everything will continue to be good. Any warning is dismissed as baseless pessimism. Conversely, when the market is on the opportunity side, you will see valuations fall to rare lows. Stocks are sold off below their real asset value. Real estate is sold cheaper than construction costs. Credit is tight. Banks refuse to lend even to good customers. The primary bond market is almost frozen. Sentiment is pessimistic. The crowd believes risk is unbearable. People think this collapse will last forever. Every call for opportunity is considered an illusion. In both cases, the important thing is not to wait for absolute certainty. When a peak is widely recognized, it has already passed. When a bottom is confirmed by everyone, the opportunity has also slipped away. Investors must act when there is still ambiguity, when the evidence is not yet complete, but the extreme signals are clear. Recall the 2008 crisis. Before the bubble burst, real estate valuations in the U.S. had soared, subprime credit was rampant, and the belief that housing prices could only go up was widespread. The extreme signs were there, but few dared to believe them. And after the crisis erupted, when housing prices fell freely, when banks failed, when everyone believed the system would collapse permanently, that was precisely when the other extreme formed, opening opportunities for those brave enough. Wise cycle management is the art of adjusting one's attitude. It doesn't require you to pull all your capital out immediately when the market is hot or pour all your money in when the market is cold. It requires you to tilt the scales, add more defense when risk increases, add more offense when opportunity arises. In a euphoric phase, what does defense entail? Holding more cash, choosing safer assets, reducing exposure to risky investments. In a pessimistic phase, what does offense entail? Buying more good stocks when they are undervalued. Expanding positions in quality assets that have been sold off. The key: adjust behavior to the current environment. You don't need to predict tomorrow. Just by observing today, you know which way you should lean. The market will always have people who want to predict tomorrow, and they will always get attention for their dramatic forecasts. But history proves that those who observe the present are the ones with a sustainable advantage. They are not geniuses, but they are patient, cautious, and dare to act against the crowd. The conclusion here is very clear. Cycles cannot be controlled, but they can be managed with the right attitude. And that attitude is the difference between an investor swept away by the market and an investor who uses cycles as an ally. In investing, it's not always about seeking absolute opportunities. In fact, most success comes from correctly positioning oneself within the cycle, knowing when to defend, when to attack. Imagine the market as a vast battlefield. No one can completely avoid stray arrows, but a wise warrior always knows when to duck behind a shield and when to draw a sword and charge. For investors, the shield is defense and the sword is offense. In stages where the cycle leans towards risk, the most logical action is to strengthen defense. Defense doesn't mean fleeing the market, but adjusting how you participate. Maintaining a higher cash allocation to have room to react, choosing safer assets, prioritizing businesses with strong balance sheets and stable cash flow, reducing exposure to high-risk investments, hot stocks, low-quality high-yield bonds, or deals too reliant on leverage. Conversely, in stages where the market sinks into extreme pessimism and valuations are compressed to irrational levels, offense is the wise action. Offense also doesn't mean recklessness, but daring to buy when the crowd flees, daring to expand positions when prices are so cheap that opportunity far outweighs risk. The core point here is not needing to know precisely whether today is the peak or the bottom. Just recognize which extreme of the pendulum we are near. If the market is too hot, no need to wait for more evidence, lean towards defense. If the market is too cold, no need to wait for anyone's confirmation, lean towards offense. This sounds simple, but in reality, it is one of the biggest challenges, because humans are inherently driven by crowd psychology. When the market is rising, a sense of security deceives us into thinking risk has vanished, making us want to attack more. When the market is falling, fear makes us retreat, even though that might be the time to attack. Success in positioning within the cycle comes not from superior intelligence, but from discipline and the courage to go against the flow. To defend when everyone is euphoric requires patience. To attack when everyone is desperate requires courage. I have seen many investors fail not because they lacked knowledge, but because they mispositioned themselves within the cycle. They attacked when the market was too expensive and defended when the market was too cheap. Conversely, the most successful people I know all share one thing: they know how to tilt the scales at the right time. Positioning the cycle is not guesswork, but the art of looking directly at current reality and accepting what it shows, even if it contradicts one's own emotions. Positioning within the cycle is not an all-or-nothing game. It's not about pulling out completely when defending, nor is it about investing all capital when attacking. It's like turning a steering wheel, gradually adjusting towards a safer or riskier direction depending on the environment. In a euphoric market phase, when valuations soar, credit is easy, and sentiment is frenzied, the wise action is not to flee immediately but to slow down. You can hold a lower proportion of stocks than usual, increase the proportion of quality bonds, or simply hold more cash. This doesn't help you completely avoid risk when the reversal occurs, but it helps reduce losses and keeps ammunition ready for opportunities ahead. Conversely, in a phase where the market is immersed in pessimism, when assets are sold off, credit is frozen, and valuations are irrationally cheap, this is the time to tilt the scales towards offense. But offense doesn't mean blindly buying. It means being selective, finding solid businesses, quality assets that are undervalued simply because of general fear. By doing so, you both control risk and leverage the advantage. It's important to emphasize that positioning never needs to be absolutely precise. You don't have to pick the exact day the market hits its peak or bottom. As long as you adjust your position in the right direction, more defensive when risk increases, more aggressive when opportunity opens, then over time, the results will surpass the majority. In fact, this is like driving on a winding road. You can't know exactly how many meters the next bend will be, but simply recognizing that you're entering a bend, you slow down. When you see a straight road opening up, you accelerate. Successful investors do the same with cycles, not precisely measuring, but steering in the right direction. There's an important point. Cycle positioning must always be accompanied by humility. The biggest mistake investors make is believing they have figured out the market. In reality, we can only tilt probabilities in our favor, never eliminate risk. When you apply this mindset to portfolio management, you will find that in a hot phase, short-term profits might be lower because you're not chasing the crowd. But when a shock comes, you avoid large losses and have capital to buy. In a cold phase, you might incur temporary losses by buying amid fear. But when the market recovers, superior profits will come to you. Time will prove the value of correct positioning, even if in the short term, it makes you feel alone. The great investors I have known were not always right in their predictions, but they knew how to balance defense and offense. They didn't let euphoria make them complacent, nor did they let fear prevent opportunity. And that very flexibility created a sustainable advantage. Positioning in cycles, in the end, is not a short-term tactic. It is an investment philosophy. It's about accepting uncertainty, adjusting one's attitude, and knowing that being on the right side of the pendulum is far more important than catching every swing. When discussing how to deal with cycles, I must be honest, there are limits that cannot be overcome. No matter how carefully you observe, how deeply you analyze, you cannot completely escape the influence of cycles. One of the obvious limits is that no one is immune to mistakes. Humans are inherently driven by emotions. Even if you know the theory of cycles in practice, when the crowd is euphoric, you will still feel drawn in. When the market collapses, you will still feel anxious like anyone else. Knowledge only helps us reduce mistakes, never eliminate them completely. Second, no one can be right all the time. Positioning within cycles only gives us a probabilistic advantage, not certainty. Sometimes you defend too early, and the market continues to rise for a while longer. Sometimes you attack too early, and the market still falls further. This is unavoidable, and it is the price to pay to maintain a long-term advantage. Third, the investment environment is constantly changing. Some tools that were once useful may become ineffective in a new context. Some signals that were once reliable may become distorted. Cycles have a repeating nature, but the details do not. This means there is no permanent formula. Therefore, dealing with cycles requires humility. The failure of many investors comes from the illusion that they have found a universal key to control the market. But the market always finds ways to prove that no one can control it. When you believe you are immune, that is precisely when you are most vulnerable. Another limitation comes from the very nature of investing. You cannot stay out forever. If you are too defensive, waiting for a perfect opportunity, you might miss an entire period of long growth. If you are too aggressive, believing you will escape before the cycle turns, you will get trapped when the market reverses faster than you expected. So, what is the right attitude? It is to accept uncertainty as part of the game. No one can avoid all risks, nor can anyone seize every opportunity. What we can do is lean towards what is reasonable, know how to adjust when circumstances change, and most importantly, avoid fatal mistakes in investing. You don't need to be always right, just avoid major wrong moves. A deadly blow, a large capital loss in a bad cycle, can wipe out years of gains. But if you maintain resilience, endure through many cycles without being defeated, then with just a few times of leveraging big opportunities, success will come. The limits of dealing with cycles are not a failure, but a reality that needs to be acknowledged. Accepting these limits helps us become calmer, without illusions, without arrogance. An investor is not a conqueror of cycles, but a companion to them. Knowing when to yield, when to adjust, when to be patient, that is the real strength. Cycles don't just appear in economics, credit, or crowd psychology. They are also deeply embedded in the success of individuals and organizations. This is one of the most subtle cycles because it occurs internally in behavior, yet its impact is no less powerful. The familiar pattern unfolds as follows. Success brings confidence. Confidence, if unchecked, turns into complacency. Complacency leads to mistakes, overconfidence, underestimating risk, or overexpansion. Mistakes inevitably lead to failure. But failure, if viewed correctly, becomes a lesson that paves the way for new success. This is the cycle within success, a loop no less harsh than the economic cycle. In the world of investing, examples of this cycle are abundant. A fund achieves brilliant results for a few years, attracts massive capital, and is praised as genius. Initial success makes them believe their method is invincible. They take more risks, increase leverage, expand into unfamiliar areas. Then, with just one market reversal, gains evaporate, reputation collapses, and investors flee. At an individual level, it's similar. A young investor might start lucky, reaping large profits in a favorable market phase. Early success makes him believe he has special abilities. He takes more risks, disregards discipline, and eventually the market teaches him a bitter lesson. But failure is not the end. If one remains humble enough to learn, failure is the source of growth. Many of today's great investors suffered catastrophic failures in the past. It was that experience that helped them understand their limits, avoid repeating mistakes, and build resilience. The important lesson here is that success also needs to be managed like a cycle. When success comes, know that it carries the seeds of complacency. When failure comes, remember that it hides the opportunity to learn and be reborn. This applies not only to investing, but also to business and, more broadly, to life. A rapidly growing company must be wary of the temptation to expand too quickly. An individual at the peak of their career must be sober not to fall into arrogance. Because every peak contains the risk of decline, and every trough has the potential to lead to recovery. If we treat success as an endpoint, we will be crushed by the cycle. If we see it as part of a larger rhythm, where success and failure follow one another, we will go much further. Humility in victory, patience in defeat. That is the only way not to be swept away in your own cycle. Question often asked is, can cycles be eliminated with technological advancement, with accumulating knowledge, with increasingly sophisticated policies? Will humanity finally escape this endless dance? My answer is no. Cycles are not products of ignorance or crude tools. They stem from human nature, from psychology, emotions, short memories, and the eternal oscillation between greed and fear. No matter how much we progress, as long as humans participate in the market, cycles will exist. Look back at history. After every crisis, people declare that the lessons are clear, that mistakes will never be repeated. But just one generation later, as memories fade, those mistakes return, only in a different guise. Therefore, dreaming of eliminating cycles is a dangerous illusion. If cycles are permanent, then the important thing is not to avoid them, but to learn how to live with them. This leads us to the core essence. That essence can be summarized in a few points. No one knows exactly what tomorrow holds. All specific forecasts about timing are fragile and prone to collapse. But everyone can observe the present. We can look at credit, psychology, and valuations to recognize where the cycle is. The investor's task is to identify extremes. When you see excessive euphoria, be defensive. When you see extreme pessimism, prepare to attack. Success comes from tilting the probabilities in your favor. You don't need to be right all the time, just avoid major mistakes and seize clear opportunities. This sounds simple but is a lifelong challenge, because it requires us to constantly go against the crowd, fighting against natural instincts. When everyone is wealthy and euphoric, you must be cautious. When everyone is terrified and fleeing, you must be steadfast. The market does not punish a lack of intelligence, it punishes a lack of discipline. The final message I want to leave is that cycles are the eternal rhythm of the market and of life. We cannot break them, but we can learn to listen. The successful person is not one who defies the cycle, but one who knows how to harmonize with it, when to retreat, when to advance, when to patiently stand still. If there is a secret in investing, this is it: preparation, adjustment, and patience.